Where are the prices actually still going up in 2026, and where are they starting to lose some of the price run up from the last few years? The Federal Housing Finance Agency and National Association of Home Builders data finally give us a clear answer. The appreciation story has shifted from the usual hot Sunbelt names into smaller Midwest and Northeast markets that investors ignore. I'm Robert with Open Lane Funding, and I work with real estate investors all over the country, helping them finance fix and flips, BRRRRs, and new construction projects. A month ago, Hartford, Connecticut popped up as a standout market with roughly 10% annual appreciation on the Federal Housing Finance Agency's reports. Now that we have the full picture from Q4 2025, the picture is more nuanced. National appreciation has slowed to right about 1.8% year over year, which is the slowest pace since 2012. At the same time, that new data confirms the Midwest and Northeast are quietly dominating the price growth right now. Let's start with the national headline. According to the Federal Housing Finance Agency's House Price Index, U.S. home prices were up about 1.8% in Q4 2025. That's compared to Q4 2024. That is the slowest gain year over year since the second quarter of 2012. And nine of states plus DC actually posted negative appreciation, which means almost 1 in 5 states saw prices fall over the last year. The single worst state is Florida, with prices down about 2.7% year over year. After being one of the hottest markets in 2020 to 2023, it's now on the flip side. The top performing states right now are going to be North Dakota, actually, with that 6.4% of growth, Delaware at 6.3%, and Illinois at 6.1%. Now let's talk about where prices are still moving up in a meaningful way. The Federal Housing Finance Agency's metro level data ranks Reading, Pennsylvania as the number one appreciating market among all major metros, with about 8.4% growth year over year and more than 62% growth over the last 5. Right, and that's all right behind Mount Pleasant, Wisconsin at 8.2% annual appreciation, and Syracuse, New York at just over 8%, with nearly 70% growth over the last 5 years. You see these right now you're seeing strong market appreciation in the Chicago area, Atlantic City area, and New London area. Most of them showing 6 to 7% annual gains and 50 to 80% cumulative appreciation over the last 5 years. The single strongest metro for the last period is actually the Allentown, Bethlehem, and Easton, Pennsylvania, and New Jersey area. They're clocking in roughly at 8.9% year over year. The pattern is clear. Many of the top performers are still small to mid-sized Midwest and Northeast markets with constrained supply and still affordable prices. Now, about the bigger names everybody knows. In the large metro category, places like Boston, Richmond, Columbus, they're all seeing solid but moderate appreciation, roughly 3.8% to 4% year over year, with the 5-year gains in the 48 to 56% range. Meanwhile, some of the pandemic era boom markets are clearly downshifting. You got Jacksonville and Miami, they're only up about 1.5 to 1.8% year over year, even though Miami has nearly about an 80% price growth over the last 5 years. On the softer side, you have areas like Dallas, Plano, and Irving, Texas. They are slightly negative at negative 0.3% year over year. And Orlando, Florida is down about negative 2.7%. The single worst major metro right now is actually in Florida. It's the Cape Coral and Fort Myers area. That's dropped about 9.1% in a year. In a year, that's the sharpest correction among the 100 largest markets in the country. That's the backward-looking data. All right, so let's look ahead at where prices are expected to rise next. House Canary's Q1 of 2026 appreciation forecast highlight a very similar theme. Smaller, more affordable markets are projected to lead the next leg of growth. Markets like Brunswick, Georgia, are forecast growth up to 7.1% year over year. Grand Island, Nebraska, sitting at around 6.3%, and Glen Falls, New York, at near 5.9%. Midwestern cities like Jackson, Michigan, and Rockford, Illinois, are also expected to see stronger than average appreciation at 5.8% and 5.7% respectively. And the familiar names like Syracuse, New York, and Hartford, Connecticut still show up again. They're roughly about 5% forecasted growth. So, what do you think of all this as an investor? First, the appreciation play is no longer the big, flashy Sun Belt and Mountain West metros that exploded from 2020 to 2023. Many of those markets are now flat or negative and are still digesting the run up. Florida as a whole is showing negative appreciation, and places like Cape Coral or Fort Myers are in a full on price correction. The second is the real opportunity in 2026 is in those small to mid-sized Midwest and Northeast markets where inventory is tight. Prices are relatively accessible, and both the Federal Housing Finance Agency's history and House Canary's forecast are pointing in the same direction. They're aligned. If you are focused on long-term holds, BRRRR strategies, or value-add projects, these are the markets where you can still buy below replacement cost and ride modestly, a modest but steady appreciation instead of gambling on a bounce back in overheated markets. So if you want help figuring out which of these markets line up best with your budget, your strategy, and your financing options, that's what I do every day. Send me a message with your price range and your strategy, buy and hold, BRRRR, or ground up, and I will identify a short list of metros that still have room to run based on the latest data. I'm Robert Holman with Open Lane Funding. And if you found this helpful, please hit like, subscribe, or follow, and I'll see you on the next video. Thank you, everyone, and have a great weekend.